Hello, you're watching Dukascopy TV, and today we're focusing on Australia again as the RBA and the country's government faces challenges that not everyone necessarily understands. On the one hand, the Australian dollar is rising against the euro to the highest it's been since June this year. But at the same time, there's the problem of low interest rates affecting small to medium-sized businesses. And then, of course, there's that ballooning housing market, not to mention the US shutdown rumbling in the background. Well, joining me on the line to take a much closer look at all this is Sean Callow, Senior Currency Strategist at Westpac in Sydney. Mr. Callow, thanks for joining us. Before we take a more refined look at the Australian dollar in a little more detail, let's just have a look at yesterday's RBA decision. Given the current financial climate for domestic business right now, was it right of the RBA to keep the benchmark interest rate as low as it is, currently at 2.5%?
Yes, well, it's certainly no surprise that they did keep steady because they have given the indication that they're in a wait-and-see mode. On the positive side, there's been a big bounce in business and consumer sentiment after the election and just before it, so late August into September and early October in the confidence measures. And the RBA wants to see whether that translates into any increase in business and consumer spending. They give the impression that they probably think it's doubtful, but they're willing to give it some time and see how it goes. They do want to allow some more time for previous easings to work their way into the economy. So they see signs that interest-sensitive sectors are showing some recovery, including housing most notably. But overall, for us, it's as the RBA said, the economy is growing below trend, and we think it's only really running at about 2.25% at the moment, whereas it could be running 3.25% trend growth. So there is room for further easing down the track, but it just looks as though they don't want to touch the cash rate near term.
In the meeting minutes, members agreed that the bank should again neither close off the possibility of reducing rates further, nor signal an imminent intention to reduce them. Now, this indecision may work for the short term, but how will markets react in the medium to long term if this is the only rhetoric to come out of the RBA?
Yes, at some point they're going to have to drop that line. It's becoming a little bit more familiar now for them to indicate that they still think that if they did change rates in the next few months, it's still more likely to be a cut. And there's no indication that they're serious about a hike. But it is reflected in a very indecisive money market. The implied interest rates in the markets are that there's about less than a 50% chance of another rate cut in the next few months. But they are leaning towards that cut by February, about 9 basis points in total. But over 12 months, the cash rate pricing is up by 10 basis points. So the market's really not quite sure what to make of it, and I think in the next couple of months the RBA will have to decide whether the economy is soft enough for them to strengthen that warning of another easing, or whether they're just going to signal that they think that on hold that the rates have bottomed for the cycle.
Now, I spotted a quote yesterday from the Senior Vice President at Macquarie Bank saying that the Aussie is being supported by, and I quote, no new rhetoric on interest rates and no new rhetoric on the currency front. Is this enough to keep the Australian dollar rising against the kind of range of currencies we've seen so far, or are you projecting a ceiling to be hit soon?
Well, it's certainly a good point in terms of the lack of fresh rhetoric on the currency. The RBA did say that while the Aussie had risen recently, it was still about 10% below its level in April. And the implication there is that they think that the overvaluation that they perceive has been removed, and that therefore it's probably not causing them to lose much sleep at night. But whether the Aussie can continue from here, we think near term it can probably rally a little bit further. The concerns over the Chinese economy that were at their deepest in the second quarter of this year, those have eased somewhat. The market's more optimistic on the outlook for Chinese growth into next year. Iron ore export volumes are very strong, so that's a positive. Other commodities are more mixed, so we're still a long way from those highs of April in terms of a basket of commodities. So it's I'd say a cautiously positive outlook near term, but not exceptionally bullish because the growth in the economy is just a bit too slow, and our house view remains that there will be further rate cuts because of that weakness in the economy underlying, and that those will materialise in early next year.
Now, as a strategist looking out for Westpac, are you confident the RBA and the Australian government can realistically maintain a healthy currency, battle a rocketing property market, whilst dealing with other key issues such as rising levels of unemployment? Or is the RBA rate decision really about stalling for time whilst officials figure out what to do next?
It's an awkward combination for sure. There is a lot of activity in the housing market. Prices are very much under on upward trend near term. That's likely to continue because supply is just not keeping up with demand. So the construction is really lagging the growth in demand for Australian property. So that's awkward for the RBA. There's no doubt they would like to see the currency weaker. They're willing to tolerate it higher, and they're not too worried about it. But it's certainly not at their ideal level. I think it's fair to say exporters are still struggling, and there is a danger that over the next few months, if after the US fiscal drama, that's probably going to have a negative impact on the US economy going into next year. It'll keep the Fed printing money at full pace, which should undermine the US dollar and boost the Aussie against the US. So that combination means that we probably aren't going to get much relief on the currency front.
Okay, thanks for joining me today, Mr. Callow. Our other interviews today include a look at housing in the US, New Zealand CPI figures, and an update on Italy's economy, as the country's political elite remain under scrutiny. But I'll see you next time. Goodbye.